Well, good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is March 11th. It's actually a Thursday. It's the fourth day of the second trading week in March of 2021. And boy, what a difference from a year ago. Let's talk about the futures, and then I'll get into the whole thing, and I'll give you a couple of stocks. I'll give you a good long stock pullback, and I'll give you a short stock pullback. And I think you're going to want to watch and possibly trade both of them. So don't go anywhere and stay tuned. Now, NASDAQ is up big, 240 points. S&P's up 28. We had a really good day on blue chips yesterday. The Dow made a good gain. NASDAQ was Big report today. We got jobless claims. Yesterday we had consumer data and inflationary data, and I'll get into that in a second, but we have jobless claims. It's coming up in about 21 minutes. We're about an hour and 21 minutes till the opening bell, but it comes out, this report comes out an hour before the opening bell. It's a really important report, and the reason is because it gets released last Friday. It's not lagging. It's not like 1 month behind. It's only a week behind, and the number of jobless claims has actually been going down. The 4-week moving average is now at 790,000, and just as we go down to the low 700s, we get a surprise uptick again. Then we go into the low 700s, and we get an uptick again. And then when you look at this, it doesn't look all that different than it looked a year ago, which is quite disappointing. But I finally think we're going to get some downside, which means lower jobless claims, lower applications for benefits. So consensus is 725,000. I'm a little skeptical based on the boy who cried wolf, the reports we've been seeing, because every time we go to the 700s, it comes back up. Every time I think we're going to break 700, it goes back up. I'd love for this sucker to break 725, show us a number of 710, maybe 700. That would be very, very bullish for the overall stock market. Talking about the overall stock market, let me just show you where the NASDAQ is. The NASDAQ is still trading below the 50-day moving average. If you look at the S&P 500, on the other hand, it looks very, very different. It's almost at new highs. New highs are at 395. We're at 391. We're 4 points away. And if you look at the Dow, we literally hit all-time highs. And the Russell doesn't look all that different. So all the indices, I mean, look at this. All-time highs around 230. We're at 228.74. But the NASDAQ, the large cap techs are being beaten down. Why? Interest rates. They're very sensitive towards interest rates. Interest rates are going up, and investors don't believe they'll yield as much out of the large cap techs as they will from non-large cap techs, because usually the more volatile the stock, the more return it gives, the more risk, the more reward. But in this case, there's a doubt about that. So the large caps are going to have to prove themselves during earnings next quarter before they go up to new highs again. And I believe, and yes, I do believe this is just a pullback. I think we're going to go to about the 224, hit maybe the 50-day moving average, maybe even flirt with the 229, 230 level. But I don't think we're going to hit all-time highs, and then we're going to back away again. And why do I believe that? I'll show you why. There's a very specific reason why. Because if you look at the NASDAQ 100, you will see that momentum levels in terms of stocks trading above the 200-day moving average, and I go through this every single day on a 20-year basis, is coming down. It's not coming up. And this is telling us momentum levels were at the highest level in 11 years, and now they need to come off. So let's talk about global economy, and then I'll show you a couple of stocks that I'm looking at right now. So stocks climbed in Europe and Asia overnight after a key measure of inflation in the U.S. came in lower than expected. That's right. We had yesterday, let me just show you this. We had yesterday the CPI report, Consumers Price Index report, and Friday we have the PPI. So now we have a good idea of whether consumer prices are going up. And on Friday, we'll have a good idea of whether producers' prices are going up. And that'll give us a really good indication of how bad or how good the inflationary pressure is. Labor Department reported U.S. consumer prices. That's what I was just showing you. A key measure of inflation at the consumer level rose 0.4% in February, the biggest gain in 6 months, led by a jump in gas prices. But core inflation, excluding food and energy, posted a much smaller 0.1 gain, easing fears that inflation might surge as the economy recovers from the pandemic. Because everybody's been really scared because the long-term rates have been going up, as you could see here by the bond market. This is inverse. Bond market goes down, interest rates goes up. Now, I want to show you guys this is not a really big bounce. So we'll get into that in a second. Let me talk more about global economy. Yield on the Treasury note slipped to 4.9% Thursday after rising as high as 1.6 last week. That's this. This is when it went to 1.59 or 1.6. And this is what they call easing. Do you guys call this easing? I call this a pitiful bounce. Really. And it looks to me like we're going to revert back down or stay around these levels. And this is very correlated inversely to the NASDAQ 100 right now. Let me go back to the NASDAQ 100. Sorry, I'm jumping back and forth, but I want to give you guys a really good picture of why and how, and kind of get you guys under the hood so you understand why things are happening. So you see this? If the bond market goes up, 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 interest rates go down. If interest rates go down, NASDAQ will go up. If the bond market continues sitting right here or goes down, interest rates go up. And if interest rates go up, the NASDAQ will go down. And I don't think we're going to go up all that much because I don't think interest rates are going to be jumping back to the 50 or the 200-day moving average. I think the fact that they've made this downside all the way from 0.94 to 1.6, I'm using interest yield. I'm using the inverse opposite of this. So I'm not reflecting these prices. These are bond prices. And bond was at 153.54. Interest rates were at like 0.93, 0.96. They were less than 1%. And this dump here caused them to be at about 1.5, 1.60 on the yield. So that causes bonds to go down, and that causes tech stocks to go down as well. So let's look some more at the global economies. Traders also bid up shares in smaller companies. Oh yeah, Russell was really good yesterday. Investors are also betting that the $1.9 trillion in government stimulus will help lift U.S. economy out of the COVID-induced malaise. And price per barrel for crude oil was at $65 per barrel. And I believe this price will go higher. I think we still have a lot of demand supply issues with OPEC, but with the world going back to normality, all the sentiment studies are showing people want to get out. They want to go back to normality. They're going to use more transports. They use more cars, more oil to move around. The world is not all on EV just yet. We've got about 8 years to go till that happens. So the demand for oil is going to go up, which is why energy prices are going higher. And that brings me to what I'm going to talk about today. But I know I'm jumping back and forth, but you can always rewind this video and go through it a few times. But here's what I want to show you. I don't think the NASDAQ is going to go up all the way. I think it's going to kind of huff and puff, sucker a bunch of weak hands in again, and then fall and eventually hit the 200-day moving average, shake out. Earnings will come out, confirm that earnings are better than expected, and they can withstand higher interest rates or yield more than the interest rates are showing right now on a 12-month trailing basis, and then they'll come up. But I think we need to see a washout, and that's going to take a little time. That's going to take maybe a month or so. So be very cautious on large cap tech right now, like the FANG stocks like Amazon. I mean, look at Apple. I mean, this was a darling of 2018, 2019, 2020, and look at this thing. And again, numbers aren't looking that great. It's very hard to pull a rabbit out of your ass every 10 years. And that's where that's where Apple's at right now. So be very, very cautious. Even at companies like Amazon, they're struggling right now. They're struggling. They're not dying off, but they're struggling because of interest rate pressure. So you're going to have to keep your eye on this bond market. If you see bonds rise, tech is going to rise too. If you see bonds fall, tech is going to fall too. And usually when you see a down move like this, you see a pullback that's bigger than 1 day. And in this case, we huffed and puffed for 1 day and then we reverted lower. That doesn't look like much of a bounce. And if you don't see a big bounce when you have a big move down, the odds are it's going to revert back, or it could just kind of sit and go sideways for a while. And that doesn't bode well for the NASDAQ 100. Now, I've got something really interesting for you. I got a long trade and a short trade. Let's start with the long trade. This is PDC Energy. What does the company do? You probably guessed by now. It's an explorer, U.S. explorer. Petroleum, natural gas. Natural gas is heating up. And remember, we're getting towards the summertime. And develops, explores crude oil, NGLs, natural gas, operates primarily in the west and eastern region of the United States. The company also focuses on developing drilling programs in resource plays, which is huge, huge, huge. Look at the one-year return on this stock, 362%. Do you think the stock is hot right now? And it's in the Russell 2000. You guys know how much I like Russell 2000 stocks. So it's not a large cap, and it has some exposure to natural gas and petroleum. And if you look at the stock, you will see that the stock has been, let's see here. It's not an all-time high, but it is at a 2-year high, all right? That's significant. It's at a 2-year high. The stock is making swing highs. It pulled back for 2 days, and it looks like it's coming back up, and it looks like it's going to try to test out a new high. So I like buying this around the 40 level, liquidating it on a stop right around the 36 level. I would risk half of your profit, so risk times your risk by 2, and that's your profit target, and add it to your entry. So I like the stock, PDC Energy. I do like the stock, and I think the price target of the stock, I think we're going to go all the way to the $50 level over the next 12 weeks. Next stock, and this may be a surprise for you. This was a hot stock 6-7 months ago, but it peaked out. Remember AstraZeneca, they were going to develop the COVID vaccine, and they may, but things are a little dicey. They didn't get approval in the US, not yet. The stock peaked out in the summer of 2020, and it's been going down since. And look at this, every high has been lower. It's trading below the 200-day moving average, and right now it looked like it hit the 50-day line, and it's backing away. So if you look at this stock, it looks like it's headed down. I would sell it right around now, maybe wait for it to fill the gap here, and put a buy stop right above the 50-day moving average and take profit when it drops below this level right here. So my entry would be right around the 49 level, a little above the current level, which I think it's heading that way anyway. It's going to open, nope, it's going to open down a little bit. But anyway, right around between 49.50 and 49, put a stop loss at 50.50, like $1.50 risk, and ride the sucker to the 46.45 level. Ticker symbol AZN. Now, before you go, I've got something important for you, something big. Now, I spend the majority of my time talking about how to reduce risk. You guys know that. Risk, risk, risk. Risk is everything. And when the market is volatile, like right now, I think you understand why. Risk is huge, folks. Profits take care of themselves if you watch your risk. Now, a good way to decrease risk is by minimizing the time you spend in your positions. Makes logical sense, right? In other words, get into a trade before a large move, then get out quickly. Quickly. In, out quickly. But no day trading. We don't want day trading. Day trading doesn't lock in enough profit. As a matter of fact, Future of Wealth head trader Lance Ippolito, he just made a career. He's made a career out of these 24-hour trades. He deciphers data from the options market. This is very, very cool. And then he uses it to strike moments before a stock jumps or crashes. If you're tired of market roller coaster and hate watching your positions plummet, click the button below. Watch Lance explain and prove his strategy. Again, this guy has made a career out of these 24-hour trades, deciphering data from the options market, using it to strike before a stock jumps or crashes, in and out in 24 hours. Who doesn't love that? Who does not love that? Again, folks, if you're tired of watching this roller coaster and hate watching your positions go up just to break down and erase all those profits, you guys know what I'm talking about. Click on the button and watch Lance explain his strategy. You've got to check this out. Lance is in the peak performance right now. He's an expert at minimizing the time you spend in your position and maximizing your profit potential. And not only do I want you to click on this link below, but I want you to like this video and subscribe to this channel if you're watching on YouTube. Stay ahead of the market by being the first to be notified when we post new videos. And I want you guys to have a great day. Friday's tomorrow. Keep your eye on this AZN and PDCE, and I'll talk to you guys later. And send me some love letters. Support at marketgeeks.com or just post below this video. I want to hear from you. I want to hear everything you guys have to say. Ask me questions. I'll respond live. Bye. Have a great day.